Good evening, ladies and gentlemen. My name is Oindrila Das, and I welcome you back to this month's webinar on measuring product and customer level profitability. This webinar is presented to you by MyCFO in association with Ascent Foundation. Before we begin, I request all of you to please put your devices on mute to avoid any background noises during the session. Kindly note that you may ask your questions during the Q&A sessions by writing down your questions in the chat or message panel of this platform. Conducting today's session is Mr. S. Venkat. I take immense pleasure in introducing him to you. Venkat is a qualified chartered accountant, cost and management accountant, as well as a risk manager by qualification, and an entrepreneur and category creator by vocation. Venkat is co-founder of MyCFO, India's largest and fastest growing service provider of CFOing and finance effectiveness solutions. At MyCFO, Venkat has built and led a team of 160 team members on roles and over 1,000 personnel servicing more than 350 clients in 6 Indian cities and 8 countries, including US, UK, Middle East, Nigeria, Russia, and the South Asian market. He has been actively involved with over 65 PEVC funds and their portfolio companies. Venkat's motivation is to leverage skills in the finance and accounts domain to assist business owners and investors to scale up and monetize their businesses. He has worked with promoter groups and managements across industry verticals, business sizes, stage of growth, and has seen a variety of business and finance situations. Prior to starting MyCFO, Venkat was Director, Finance and Corporate Affairs at the Indian subsidiary of Hines, one of the largest private-held real estate developers in the world. He has also been CFO at the India subsidiary of Aon, the world's largest reinsurance broker. Venkat did his articleship and early career at PwC, the world's largest professionally services firm. Thank you, Venkat, for conducting this session for us. Over to you now.
Thank you, Indrila, for that lovely introduction. Welcome once again to everybody who is part of this webinar. As always, we are delighted and honored to be partnering with Ascent to bring you this webinar on product costing and pricing. So what are going to be the 3 top takeaways from today's webinar? One, we will obtain an understanding of what are the different costing models in use and what are the situations in which this would be useful to you. The second takeaway, we would understand what are the building blocks or the components of a costing system and how does one go about implementing a good quality costing system. What we hope to do is also to leave behind with you some resource tools that you will be able to use at the end of this webinar so that you can try and implement something at your respective companies. So what are the typical problem statements that a business owner or a head of finance has? In a bidding situation, when you bid for a customer contract, you think that you will make 18% gross margin. But at the end of the project, you find that you made only 7% and you don't know why. My profits are reducing, but I'm not sure in which product and in which customer I'm losing money. I'm very clear about my direct costs and gross margin, but below the gross margin, I'm not sure how to deal with overhead costs. You have an overall idea of how much profit you will make from your fast-moving items, but you're not happy with an overall idea. You want to get an exact idea of how much profit you're making from each product. Does your team take too long to get you details about your product cost? So you ask them for the information. Are they able to respond to you immediately? Or do they come back to you maybe in 2 weeks' time, by which time it's too late for you? You want to be competitive when bidding for customer contracts. So you obviously want to keep the price low, but you do not have the exact costing with you. So you end up putting some buffers and you provide a pricing estimate to your customer, which is not very scientifically calculated, and sometimes you end up losing the bid. So these are typical problem statements when you do not have a good quality costing and pricing system. So the takeaway here is that these are different symptoms. They all look like different types of problem statements, but the underlying cause is one, which is that there is a lack of a well-defined and a properly documented costing system. So who is this webinar meant for? Who will get the best benefit out of this webinar? So one is business. If you are a business owner or you are an SBU head, SBU is a strategic business unit. So if you're a departmental head, you're a factory head, you're a product head, or if you are the head of finance, you are likely to get benefit from this webinar. Especially if you are in a company that does not already have a formal costing system, if you do not have an exposure to the theory of costing, if you are in a company that is not too small and not too large, so let's say you're a mid-sized company between 20 to 200 crore approximately, your company has got some form of an MIS, but it's not a very mature MIS. If you are a kind of company in a business model that requires frequent inputs from finance team for bids and for pricing decisions, if you are a company that requires cost saving initiatives to be implemented, if you are a company with some IT systems, but the IT systems are still evolving, or if you are a company where your operations is not fully integrated with finance from an IT standpoint. So if you fall in these categories, then you're most likely to get good value from this webinar. Some of you who are running more sophisticated organizations, if you already have a good quality costing system and you want some ideas on how to optimize it further, maybe this webinar might not be that useful to you. So please get in touch with us separately. We are happy to help you out on a one-to-one basis. But if you do not have a formal costing system and you're a mid-sized company and you're struggling with pricing decisions, then maybe this webinar could be useful to you. So a quick snapshot of what we get and what we actually need. So what we have on the left-hand side of the screen, I'm not sure if you can see my cursor, what we are calling as a classic P&L structure, which is an accountant's dream. So all of you are familiar with your ledger that you get from your a P&L that you get from either Tally or from an ERP. So you have your revenue, your cost of production is calculated as opening stock plus purchase less closing stock. That gives you your material consumption. There are some factory labor costs, factory supervisor costs that ultimately will give you your gross margin. After the gross margin line, you have the overheads, which could be your central salaries, traveling and conveyance of the salespeople, quality control function, some business promotion, marketing and branding, some consulting fees, which then gives you the EBITDA line, which is earnings before interest, depreciation, and tax and amortization. After EBITDA, you have depreciation, you have interest, and finally that gives you profit before tax. So this is a P&L that I think most business owners and most head of finance would be familiar with. Now, this is what we normally get. This is accounting data. This is a classic P&L, which is what an accountant would deliver. Now, what we actually require is information at an SBU level. So what do you mean by an SBU or a strategic business unit? The definition varies from company to company. An SBU is a unit basis which you plan the performance of your company. SBU is a unit for which you have somebody senior in your organization that you can hold accountable for performance. So let's say you're a manufacturing concern, and let's say you've got 3 factories. Then each factory, if it has got a separate manufacturing head or a separate production manager in your business, the factory could become an SBU. So now the function or the job of the costing system is to convert what is the accounting data in the P&L and tell you how each of your SBUs are performing, right? So in this case, in all the cases, if you look at the profit before tax, where my cursor is, it's about 45. Let's say this is crores, or let's say it is lakhs. Okay, so it is 45 lakh rupees. The same 45 lakh rupees is coming here as well in the factory P&L. Now, how is it different? How are these two statements different? Is if you look at the gross margin line, where you got about 250 lakhs of gross margin. This gross margin has now been split by factory. And how that has been done? It has been done by refiguring your data capture systems so that the costs are getting attached to every factory separately. So here, not only is a ledger code used, so in this case, for example, we are seeing that a ledger code called factory labor cost is a P&L expense code that has been used. But in this example, not only is a ledger code of factory labor cost used, we have also attached a cost dimension called factory 1, factory 2, and factory 3 to it, so that when you want to analyze the performance better, you are able to split the cost by your SBUs. So the same 250 lakhs of gross margin, you can now see which factory is contributing to how much of that gross margin, right? So obviously you got a 25% gross margin overall, but you're able to see that factory 1 and factory 2 are doing well below the average, and factory 3 is doing very well. Now let's look at overheads, which is where things become very interesting and which is where most business owners have got a problem. So this entire overheads, which in the P&L is sitting in different lines, is coming to say 135 lakhs. What a costing system does is to allocate, and we will understand what is the meaning of the word allocation. This 135 is split or distributed to each of these SBUs on a certain basis. Now, what the basis could be is something that we will see later on in the presentation. Here, what we are seeing is what is going to be the end output that you will get. So if you are on the left-hand side of the screen, if this is what most people get, which is to see the P&L, how can we see the same information by SBU? That is what we're seeing in this chart. But as we go along, we will see how to split this overhead into each of the SBUs separately. Right. So here you obviously arrive at the EBITDA, which is the same as over here, except that the EBITDA is now split by factory. Similarly, depreciation has also been split. Usually, depreciation is split based on the gross block of the assets that are employed in the business. That then gives you your earnings before interest and tax, and then finally you have the interest and finally the PBT. Now, what we've done is to provide a slightly different dimension. Some companies choose to keep their SBUs as customers. So if let's again continue with the manufacturing example. So for the same company, the CEO, or if you are the business owner of this company, could say, it is interesting for me to see that this 45 rupees of PBT, which factory is contributing to how much, but I also want to see which customer is contributing to how much of this 45 profitability. So it is a different way to view the same information. So the principle remains same, that your gross margin again is now been split by customer, your overheads are split by customer, your EBITDA is split, your depreciation is split, and in fact, in this company, we've gone one step further to also split the interest. Now, this is interesting because more and more business owners are now saying that why should interest, which is being incurred, let's say, on your capex loan or on your working capital loan, why should that be absorbed by the head office? That should be absorbed by the factories or the customers as well. So in this particular case, we have allocated the interest based on capital employed. So let's say if customer 1 is paying you with a 90-day credit period and customer 2 is paying you with a 120-day credit period, then the allocation of the interest has been done more towards customer 2 instead of customer 1, because more of your working capital and therefore more of your interest is being incurred in servicing customer 2. So what this now does is that the profit before tax of 45 at a company level, you are actually being able to see that which customer is contributing to how much of that profit. Now, one of the things that we're not going to go into too much detail is, why do you need a costing system? I think that to me is somewhat obvious, because just from this example, when you're able to see that this customer is giving you 550 rupees of revenue, but is giving you only 8 rupees of profit, it tells you that you need to do probably something different. The next time when the negotiation with the customer comes on pricing, you need to be more aggressive to look for a price increase, right? Or let's say if customer 2 comes to you with a servicing request for which you're not likely to be charged something extra, you're more likely to help him out with the servicing request because you know that you're making a fairly decent amount of profit for the revenue that this person is giving you. So a good quality costing and a pricing system allows you to take better quality commercial decision making. So what does a good costing system do? It helps you to transition your understanding. So you move your understanding about costs and profits, which is largely from an accounting standpoint. It allows you to move it more to a business standpoint. So instead of looking at only ledger codes, it tells you what is your SBU performance. The second thing it allows you to do is to help you understand what is the impact of your common cost, which is your overheads, on each SBU. So this is the two objectives or the two functions that a good quality costing system should achieve. Right. Now, a little bit on the theory of costing. So again, for those of you who are already familiar with this, please bear with me for 2 to 3 minutes. For those of you who are not familiar with different costing systems, you will definitely find this useful. So broadly, there are two costing methodologies that people use. One is called marginal costing, and the other is called standard costing. Project costing is used for project-based industries. So let's say if you are an EPC company, then you would use project costing. If you are into project manufacturing, let's say you're manufacturing specialty walls which are all made to order, or let's say heat exchangers which are all made to order, then you would be a project costing company. Activity-based costing is more common in manpower-intensive industries like, let's say, a BPO or a shared service center. I'm going to focus my attention a little bit more to marginal and standard costing because those are the ones that you're most likely to see and probably use. So when you use marginal costing, what are the commonly heard terms? You would hear terms like contribution and break even. These are more commonly used in marginal costing. Marginal costing is used across all industries. It applies to manufacturing, trading companies use it, services companies use it, including new age services companies. Let's say if you're an education company, you're a sports goods store, you could be a restaurant chain, marginal costing is still likely to be very useful to you. So some of the features of marginal costing is that it is most commonly used and practiced. It is very easy to implement and refine. And if you do not have a costing system currently, then this is usually the first type of costing system that a company would look to implement. So marginal costing is in concept extremely simple. I'm going to give you some numbers, and because you're business owners, you'll be able to quickly get this, that if a product is priced at 100 rupees, 100 rupees is the cost of one unit of your product, and let's say that your cost of manufacturing is 60 rupees, it gives you a gross margin of 40, right? And this is per product. Now let's say that your total overheads is 40,000 rupees, right? Just a simple example for you to understand. 100 rupees is revenue per unit, 60 rupees is the cost of manufacturing, 40 rupees is your gross margin. If 40,000 rupees is your overhead, then your break-even point will be 40,000 rupees divided by 40, which means that you need to manufacture at least 1,000 units. You need to run your factory at least to that level to be able to break even. Anything more than 1,000 units automatically means that you will be making a profit, right? So that in extremely simple terms is how a marginal costing system would work. Standard costing uses slightly different terminologies. You would hear something called target costing, which is more a function of standard costing. You would hear things like material, labor, and overhead rates. Now, these are the three components of a standard costing, that there is a material rate, there's a labor rate, there is an overhead rate, and together this would be the components of the product cost in standard costing. You would also hear something called variances. So what's a variance? A variance means that you have fixed a budgeted cost or a standard cost. So you would say that, let's say if I have to manufacture a chair, then the cost of plastic in a chair should, let's say, be 1,000 rupees. Now that is a standard that you have fixed. Now it is quite likely that your actual cost of manufacturing is not 1,000 rupees. The actual cost of manufacturing comes to 1,100 rupees. Now this is called an adverse variance of 100 rupees. It's a negative variance of 100 rupees. Now what a standard costing system helps you to do is to break the variance. So let's say if 100 rupees is the adverse variance, It will help you to break it into rate variance. So is it that you manufactured over the cost because your raw material cost went up? Is it because of the mix? So instead of manufacturing chairs of a particular type, did you end up manufacturing chairs of a different type? Or is it because of usage, that let's say you should have used 4 kilos of plastic in making the chair, but you ended up using 5 kilos? So all of these three factors could contribute to an adverse variation, adverse variance in the material standard. So these are all typically terms that get used in a standard costing model. Standard costing is extremely common to see in manufacturing. In fact, most sophisticated organizations would have had hardwired standard costing into their ERP system. So if they're using an SAP or an Oracle or an Navision or an Accepta or an Infor or a JD Edwards, typically the standard costing would have been set up as a part of the production and planning module to help the operations and productions and finance team to measure the variances. So standard costing is obviously a lot more technical than marginal costing. It requires more maturity in the data capture process. So what do I mean by data capture process? The place where the data is going to be captured, it requires maturity in that process. So if you're on something like Tally, it is far harder to implement something like standard costing as opposed to marginal costing. However, it is ideal from a cost control standpoint. The best system that can help you to achieve targeted savings would be a standard costing system. It's highly effective for productivity improvements. However, on the negative side, it also requires higher maintenance. So what do I mean by maintenance is that you'll have to keep updating your standards. A standard costing is nothing but a budgeted costing. So you'll have to keep changing the standard cost at a certain determined frequency. So a lot of companies would say that, look, we will revisit our standard cost once in a quarter or once in half a year. Or they may say that all A-class costs, A-class standard costs, we will visit it once in a month. B-class, we would do it once in 3 months, and C-class, we would probably do it once in a year, right? But a constant resetting of the standard is something which is a prerequisite to a standard costing system working well. What are the common terms that are used across all costing systems? You will come across terminology like direct costs, gross margin, overheads, and allocation, all of which we're going to see a little bit later in this webinar. The key takeaway on this slide is that please do not worry about the right costing system. A lot of times we see business owners, promoters debate a lot on which is the right costing system to use. What you need is a costing system, right? Whatever system you pick, whether it's marginal, standard, project, or activity based, make sure that it is being implemented consistently. It is implemented with discipline. It will automatically get fine-tuned with time. If you do not have a defined or a documented costing system now in your company, our recommendation would be please start with marginal costing. 1 or 1.5 years of a marginal costing system running well can probably help you to move into a standard costing over a period of time. So please do not worry about what is the right costing system. Pick one and make sure that you're using it consistently. Let's now come to what are the components of a costing system. And I thought that it might be a good idea to actually share some samples or some illustrative documents with you so that you are able to get a tangible idea of how some of these things look. So I've picked 3 or 4 critical items in any costing system. So first is a costing policy document. A costing policy document typically talks about what are the objectives of the costing system. So what are you trying to achieve? Are you trying to achieve a high quality pricing decision? Are you trying to achieve a reduction in your purchase costs? Are you trying to achieve a reduction in your conversion costs? What is the quantum of savings that you're looking to achieve? Are you looking to improve the turnaround? No, are you looking to improve the reporting? So whatever the objectives are, in the descending order of importance is typically what gets defined in a policy document. The policy document would also have very clear responsibilities that will be cast on individuals who are responsible for implementing and monitoring the system. It will also summarize the principles that are involved, right? So a simple example of a principle would be what is the allocation policy that you would be following, right? So all these things would typically get condensed into a policy document. I'm going to share with you quickly. Now, this is for a industrial valve manufacturing company. We are calling it the costing framework, right? So let's not worry too much about the contents over here. I'm just going to run you through the key headings. So the intent. So what is the objective of the costing system? What is the current standing? So the reason why this company implemented a standard costing system is because they had put in $10.2 million of investment into a greenfield manufacturing facility, and they wanted to ensure that the investment in the facility is paid back quickly, right? So that was the objective of setting up the costing system. Then there is a methodology. So what are the drivers in each category of cost? And so this company identified, and this company implemented this costing system in a system called BAN, in a software called BAN, which is now called Infor. And they actually broke it down into material costs, into overheads, and operation costs. In each component of cost, like this is for material costs, they've identified what will be the basis of calculation. So it looks like you now have the Word document in front of you. So let me just quickly recap what I was taking you through. So this is the costing framework that it's a document written up in MS Word. The intent is the objective. The current standing, as I was explaining, is that a $10.2 million investment was made. They wanted to make sure that they're getting the payback quickly on this investment. They identified the methodology. So what are the three key costs, that is material costs, overheads, and operation costs, and they identified what are the drivers that will help to move these costs up or down. And in each type of cost, they identified the basis of calculation of these costs, right? Like for example, and these are this I think is a good example of what kind of things get picked up as a part of a policy document. Now, because this is a greenfield unit and they were not functioning at 100% capacity in year one, so there is obviously a ramp up period. So let's say this company was only at maybe 30 to 40% capacity utilization in year one, you will see that a lot of the costs are actually absorbed 100%, right? Things like power 100%, factory supplies is 100%. Let's just try and increase this. Yeah, it's about 100%. Maintenance supplies is at 100%. Freight is at 100%. However, admin salaries are being absorbed only to the extent of 50%. The reason why this decision was taken was because we believed that the central office or the cost of the CEO or the head of sales or production head, it wouldn't be correct to load all those costs into the cost of the product in year one. Why? Because we're still not operating at 100% capacity, right? So this example is obviously for a greenfield, but even if you have an existing plant that's operating at whatever capacity utilization, one would still be able to determine a policy for this, right? So this is now the policy for overheads. It's now a policy for operating costs, including what is the labor rate. So for instance, over here, $2.83 per hour was calculated as the cost that will be loaded into the product for utilizing 1 hour of labor. Similar calculation has been done for machine hour rate. So here it's about $33 per hour that a machine would run, right? All of these codes, all of these price calculation codes were actually set up in BAN so that the entire calculation is going to be automated, right? So all of this, now we have actually shown a sample. Now this is an example of a 1/2-inch welded bonnet that goes into a valve. We have helped them understand how it will get calculated. So there is an illustration. Now why this is important is so that any person who's reading the policy document does not have any doubt about exactly how the calculation will be done. So in this case, we have got the finished product, we have got the BOM or the BOQ as we call it, and we have put down what will be the costing for every individual component and what will be the final standard cost. So in this case, $13.53 is the final cost of manufacturing one of these items. Right, similar thing has been done. The first example was for material. Now we are getting into operating costs as well. Right, so this is to give you a quick flavor. There is really no common template or a standard way in which these policy documents are run. But ultimately it has got to we can always keep it simple, make sure that it captures intent of why you're implementing the costing system and what are the principles involved, so that anytime anybody has got a doubt with regard to why we are doing things the way we are doing it, they have got a document to go back and refer. Typically a document of this kind would get revised once in a year. Let me now go back to the main presentation. Right. So what we saw was the costing policy document. What we are now going to see is the availability of the BOM. Now, one of the things which is an absolutely critical component, and this is where the finance guys will not really be able to help much. Now, this needs to come from the production or the planning or the design people. Any good costing system assumes that you have a very detailed BOM or BOQ. Now, this is an example of an air conditioning EPC company. So this is a very large player that sets up air conditioning units in retail malls, in hospitals, in office complexes. Now, I'm just sharing this document to give you a sense of what is the level of detail that typically goes into a good quality costing system. Now, this is what has gone into one installation of theirs. So it talks about the actual air conditioning units. It talks about cassettes, etc., which are technical to that particular industry. You will see that it talks about the cost of ducts, about fresh air units, of corded and cordless remote controllers, of centralized system controllers. There are some outdoor units. Again, some cassettes. I'm just going to quickly run down. Right, so there's a PLC panel. Now we're coming to ventilation and exhaust fan. There's a separate costing for all of those. There is costing of the insulation material. There is something for acoustical insulation to reduce sound, thermal insulation to reduce the heat loss, underdeck insulation, aluminium grills, diffusers, HVAC. We're already at line 225, as you can see on the left-hand side, and it keeps going, right? And it includes things like shifting. Even the transportation cost has been included over here. So all of this is just the material component. We still haven't come to the labor component of the installation, but it's about 285 line items. And this is in one of the things which I had mentioned earlier is that there are project-based industries where project costing can be used. This is a classic example of a project costing. Right now, in a good quality costing system, availability of a BOQ at this level of detail is something which is assumed to be present. So if you do not have a good quality BOQ or a really detailed BOM, the first thing to do would be to make sure that you put that in place, because that is usually the starting point for your finance team to go out and build a good quality costing system. Let me now go back and take you through some other examples. I'm going to talk a little bit about the data structure now. Okay, so you will hear the concept of dimensions and hierarchies a lot when you look at a good quality standard costing system. So what do we mean by that? So the dimensions could be any. I'm just giving you 4 examples. So for example, one dimension could be SBU. We already seen it. It could possibly be a factory, a customer industry. So let's say you may say that I want to track the costing and profitability of all my business by, say, the chemical industry, right? And the customer group could be maybe Reliance is a key customer group for you. And within Reliance, you could possibly have 10 different customer entities that roll up into that one group. So that is what by dimension, we mean that within SBU could be a dimension within which you could choose to have a hierarchy of factories. Customer industry could be a dimension within which your hierarchy could be a customer group, and within that customer entity. Another example of dimension could be a product group. So let's say you are a QSR business, you are in the hotel business. So a product group could be food. The second product group could possibly be beverages. The third product group could possibly be events, because you have got banqueting facilities. Now, within each of these product groups, let's say if you got food as a product group, and let's say you are looking at Chinese food, which could actually be the product within which you could have a SKU, right? So if you're selling a chow mein, it becomes a SKU within a Chinese product, which is within a product group of food, right? So in any business, you can actually take your product group and drill down, and it is possible to build a costing system that will help you to capture your cost and profit at the lowest denomination, including at a SKU level. So currently, we have done a project for Danone, the very large French multinational that does a lot of nutritional food and water and several other businesses. And one of the projects there was to calculate what is the profit that the company makes at a SKU level. So it is not enough for the company to know that they are selling, let's say, strawberry flavored dahi at what price and cost and profit, but they wanted to know that for strawberry flavored dahi at 50-gram pack, what is the profit that I'm making. So that is a level to which a costing system can actually help an organization. The other obvious dimension is a department, where it could be, the values could be something like sales, marketing, production, QC, etc. Right? So we can divide this, and we can slice and dice it in whichever way we want. I'm going to take you through an Excel spreadsheet that shows you exactly how this is done. So this is now for a services company. Um, so let's say a sample ledger code, and I'm going to help you understand how something called traveling domestic, an expense code, a ledger code like traveling domestic, how can that be structured in a way that allows you to get better costing information, right? So in this particular company, which is, so let's assume a company like a Dun& Bradstreet, which is mainly into information services, into research. They have a code, and this is just an illustration. I don't know if they actually have a code like this, but let's say an illustration which says travel domestic, and then there is a code there which says 11-23-62-XX-2, right? Now, what does this mean? Right? So each of this is actually a dimension and a hierarchy, which we just saw in the previous slide. So for instance, the first two digits, which is 1, 1, it actually means the region. So this first digit of 1 means that it is west. The next one to the first one is the city. So that one actually means that it is Mumbai. So this cost of traveling domestic belongs to West Zone in Mumbai. Now let's look at the next two digits, which is 23, 23. Right? Now this next two digits defines the service line. So for example, number 2 here says that it belongs to the research service line, and number 3, which is the subcode, it says that it belongs to an auto ancillary client. So here you're now identified that this travel was done by, this travel was done for West, it was done for a travel to Mumbai, it belongs to that cost center, it belongs to this research service line, and it belongs to an auto ancillary client. Then you got something called 6-2, which is the salesperson. So the head of the sales group responsible for this client is R. Murli. So he's the person who's responsible for this expense. It will come out of his budget. And the actual person who took the travel is somebody called Shravan Doshi. Right? So you are able to identify who undertook the travel and from whose budget this is going to come out. Then XX represents the customer number. So for whichever customer you put in, you've done the travel, you actually put that in. Now, why this is important is to enable you to calculate customer level profitability. And finally, the single digit of 2 that you see is a department. So this travel cost was incurred for the sales department. Now, what is the utility of creating such a, what may look like a fairly complex code? The reason is very simple. We are trying to, what is the use of a costing system? It should help you to fix accountability on someone. So when you say that this expense belongs to the sales department, you will obviously have a sales expense budget, and somebody, maybe your sales head, is responsible for the sales expense budget. So tracking the costs in this way allows you to see what is the actual cost that he has incurred against the particular budget that has been allocated to him. Each of these dimensions, it is because you're capturing the cost at this level, you will be able to calculate profitability at each of these levels as well. So you can actually calculate profitability by zone. You can calculate profitability and costing by service line. You can calculate profitability and costs and revenue at a person level. You can do it at a customer level. You can do it at a departmental level, right? So I'm going to quickly switch out of this and take you through another example. And I also want to give you the comfort that all of this is not necessarily very complex. I'm going to share something that has been done on Tally, right? Now, this is for a school business. And it's a business that has got something like 35 centers, right? And this profitability is now being calculated. So what you see here is a ledger. On the left hand side, you can see that there is registration fees, tuition fees, etc. This is all your revenue budgets. Let me just make this a little bigger for you, right? So what you see on the left hand side of the screen is your classic ledger. You can see all your revenue items like registration fees, tuition fees, gross revenue, and you're also able to see all the costs now. Like you can see center direct costs, study material, teacher expenses, you can see telephone, internet expenses, etc. But this is obviously possible in Tally, but what we have helped this company to do is to actually capture, you can split the company profitability by every branch or every unit or every outlet of the company. And this entire work has been done in Tally through the use of cost centers. So what you see here as DEL0101 is the center name. And as you scroll towards the right, you will be able to see how many centers this company has been able to put as a part of the cost centers, right? So there are more than 40 centers that have been put in over here. So the limited point I was trying to make is that a lot of people incorrectly think that implementation of a costing system is a very time consuming and it's a very laborious affair. It's not. If you have the right people, the tools are available. I think today the tools are not a problem at all in the market. Excel itself can do a lot of work. Tally can do a lot of work. If not, there are number of light ERPs. So if you look at something like a Navision, I would call it a light ERP. There are several other tools that are available. Even before you start to go into an SAP and Oracle, there are several tools that you can actually use to help you to calculate product and customer level profitability. Let me now switch back. So I'm going to talk a little bit now about the basis of allocation, which is also which is the last component that I really wanted to cover in terms of components of the costing system. And these are just some examples. The same item of cost could be treated differently in different companies, but this is just something for you to think about. For example, depreciation is something one can directly identify, and it can be done at a product level. And the basis of doing it could be the number of machine hours. So how long does it take for a product to move from the raw material stage to, let's say, the finished good stage? So based on the number of hours the machine has run, you can calculate what is the depreciation cost for that total number of hours, and then divide that by the number of products or maybe the number of kilograms of the product that you produced during that period. Director salaries, usually a common cost item. You would typically debit it to a common department like say corporate. And how to allocate this? You can allocate this either based on time spent, if you're keeping a track of your time, or what is very common is to divide it based on the revenue. So you would typically split it to SBUs based on your revenues. Power in the factory, for example, could be an example of a direct cost, which can be debited at a batch level. Again, it can be based on the total unit reading. It's usually done on machine hour basis. It can be done tracked directly to power consumption. Office power is usually an indirect cost, so that gets allocated, and the debit goes to individual departments. So let's say you got HR, IT, and finance that are sitting as common departments. Usually power is divided based on the square feet that is occupied by each of the departments. Recruitment costs. So if you're hiring an external consultant, or if you've got a full-time recruiter in your office, usually that cost would get split to the department which is hiring. So let's say if your sales department has put in a requisition and they have used the HR department to actually close on a particular position, then the cost of that particular recruitment is debited to that particular department. Employee welfare. So let's say you do a Diwali party and many people are coming for it. Usually the allocation will happen based on number of employees, and so on and so forth, right? So there are obviously for every cost item, and your ledger could have 200, 300 expense items. For each of these, you would need to define what is the basis, at what level you want to capture the information. Is it at product level, batch level, department level, or company level? And what will be the allocation basis for each of the expenses? The good part is that there is most of the businesses, 99% of the businesses, you will find that the allocation basis is already in use elsewhere in the industry. So it's a question of getting that information and making sure that you document it and implement it properly in your organization. So I'm going to come to the last section, which is what are the tips to implementing a costing and pricing system in your company. This will take another 3 to 4 minutes, and then I'm going to stop for Q&A. So the key principle is that costing and pricing is a business project. It is not an accounting or a finance project. So it has got to be owned by the business. Finance and accounts can facilitate the costing project, but somebody on the business side needs to lead it. So who is a business? What do we mean by business side? Is that it depends again what your organization structure is. So if your factory heads are the key people who are held accountable for business performance, they become the business. Or if there are product heads who are going to be held accountable for business performance, they become the business. So whoever is heading the business has to lead this project, but finance and accounts job is to facilitate the conversation. So the only way a costing system will be successful in your company is when your managers believe that it is their tool and it is useful to them in their day-to-day working. Allocation of common cost is where we find a lot of promoters and business owners spend a lot of time and they lose a lot of their sleep. It is an art and it is not a science. Okay, so please don't worry about the basis of allocation. Take what is looking very commonsensical. Please go by that and keep that basis consistent. So for instance, if you're allocating, let's say, depreciation based on machine hours, continue doing that over a period of 2 to 3 years time. If let's say 1 year you've done it on machine hours and next year you move it to gross book value basis, then you're going to distort the way in which the allocation has done. And that means that performance of 1 year cannot be compared with performance of another year. So that is not a good way to run a costing system. So whatever allocation you use, there will always be a view that look, we can allocate it in a different way, but please resist the temptation to go on tinkering around with the allocation basis. Choose one methodology for one type of expense and just stick with that for a period of time. Generally, it's not a good idea once you've decided something to change something, anything within a matter of 3 years. Okay, beyond that, if you want to go back and revisit it, it's fine, but not before 3 years. Please try and IT enable your costing function. Why we recommend this is because a costing function's job is to ensure that there is repeatability. There is an ability to continuously iterate. So you have to keep tweaking the model again and again. And if it is a manual system, it is very hard to run. You can do a lot of modeling in Excel. Tally itself can be stretched. But if you are a mid-sized company, which is say beyond 50 crore, 100 crore, then I think it's time for you to really start thinking about a light ERP that can help you with your costing. But more IT enabled, the better it is for you. It does not matter where you start. All costing systems evolve and get fine-tuned with consistent and disciplined usage. So you will not have it is just like the planning session that we did in the previous month. It doesn't matter how good or bad your planning system is in the first month. Please don't worry. You could start at 60% level. It's okay. If you keep doing it month on month, you will definitely reach a 90% level within say 6 months time. So a lot of promoters we find want to start at 90%. And what happens is that it leads to a lot of discussions. It leads to paralysis by analysis, and the project doesn't go anywhere. So please don't worry about what level you're starting. Get started, but keep doing it consistently on a month-to-month basis. And then eventually you will find that it would be at 90-95% efficiency. You will never get a costing system which is 100% perfect. It is not a good idea to try and do a 100% perfect project, because the cost of moving from something which is at 98% efficiency to 100% efficiency is extremely high, right? So at some point there will be a cost benefit analysis where you will say, okay, I have captured 95% of my costs at a very accurate level. The balance 5%, it's okay if I use an allocation. I think you should just feel very comfortable with that. So again, in the text in blue, which is the key takeaway from this slide, is that the true benefit of a costing system is that it provides a framework that will bring all the business functions to align. So as the head of finance or as a business owner, your typical problem is that different department heads are talking in different voices and you're not sure where the reality lies. So a good quality costing system, the best benefit of it is that it's a framework that will make sure that all of these people would come together in one platform and we all agree that, okay, this is the way we are going to look at costing, this is the way we're going to look at pricing, this is the way we're going to measure profitability. The alignment that you will get with all HODs coming together is a very important value addition that you will get out of your costing system. The final thing I wanted to say is, like any project, it is important to keep communicating the good things that are happening about the project. So when you implement a costing system, it is important for you as leaders in the organization to regularly communicate to your senior leadership of about how the costing system helped you. It helped you to take a better pricing decision. It helped you to put a more scientific bid. It helped you to reduce some costs. In the initial phase, in the first 3 months, 6 months, 9 months, when the system is not fully stabilized, it is still trying to find its feet. Your help in terms of making sure that the benefits of the system are properly communicated will go a long way to make sure that the project becomes a success. So that I'm going to I'm going to stop my comments now and try and take some questions. I can see that um, there are a few questions, so I'm going to quickly take these questions and then we'll bring the session to a halt in maybe another 10 minutes or so. Okay, so one question is, are you categorizing revenue in the same way that you're doing for costs and expenses? I think the answer is absolutely yes. The reason why I didn't talk much about categorizing of revenue is that because it's an easier thing to do. It is easy to track revenue by project, by product, by customer, by channel, by geography, by product line, service line, by factory, whichever way you want to see it. I didn't talk much about revenue categorization because 99% of the companies that we see would be having correct information about revenue on all these dimensions. The problem usually is with cost and expenses, right? Which is the reason why this presentation has been largely focused on cost and expenses. But yes, the answer to that question is one should categorize revenues and one should categorize cost and expenses the same way that we categorize revenue so that we are able to calculate profitability on all these dimensions. Right. The other question that I see here is, so this is more in the nature of a comment that I think you have ignored the cost of switching over to other costing system when you say that go for a costing system. So I think it's a fair comment. So let me clarify what I was saying. I'm not saying that take an uh, between uninformed decision between marginal costing or standard costing. I mean, that is not the point. I think when you decide to go for something, think it through, implement what you feel is in your best interest now, right? But I'm only trying to caution you against changing systems too often, because generally when you implement it, many things will go right, some things will not go right, and somebody either within your company or outside will give you an idea saying, look, we implemented a marginal costing system, but you know what, we should have possibly implemented a standard costing, and then you end up changing over to a standard costing system. I think those are very dangerous situations, because that's a very expensive thing to do when you keep switching between one system and another system. So my point was not to say that rush into a decision, take your time while arriving at a decision, but once you've taken a decision, then just stick with that particular system for an adequate point of time. Okay, I have a question on, this is from a professional services firm. So what is the way to do costing for professional services industry? Okay, the very basic thing that you need is time sheeting, because the biggest cost for any manpower intensive industry, particularly which is very high on IP, like law firms or chartered accountancy firms or architect firms, would be the cost of your people. The cost of your people would be anywhere between 30 to 70% of your top line, and usually the single biggest item of expense in your P&L. So without a time sheeting system that captures where they have spent their time by project, by client, by type of work that they're doing, it will be very difficult to calculate the profitability. There are some extremely good and very, very inexpensive SaaS-based time sheeting models that are available. They're very easy to implement. In fact, several of these are app-based. So if you've got, and again, this is a classic thing in professional services that people are working out of client locations. So it allows a distributed, what we call as a distributed model. An app-based system can actually allow people to book their time online. And in fact, there is a law firm that we're currently working with, fairly large, where they're actually calculating the cost of their WAP on a daily basis because their time sheeting is happening every day, right? So the partner in charge is able to see what is the WAP, that is the unbilled time that they're sitting on a daily basis. So that obviously keeps the pressure to make sure that the firm pushes out the invoice to the client quickly without building on too much WAP. But if you need more details, I mean, feel free to get in touch with us offline. Very happy to talk you through. There is a lot of work that has been done on professional services industry. Um, okay, I can see another question. What strategies you recommend to reconcile the profitability results if they are at extreme? Uh, so customer wise and product wise. So the question here is that if customer A is profitable to service, okay, but the product that you're selling to customer A may not be profitable. Okay, so I think a great question. What we like to do is to kind of do a 80-20 rule in all these projects. So see, if you once you've implemented all of this, what you should be able to do is to get a matrix. By a matrix, I mean, so just think of it as an Excel spreadsheet where you've got your client level profitability as columns and your product level profitability as rows, right? And you will be able to then see the intersection to see that which product is making how much money for you in which customer. Um, Generally, there is no set rule with regard to which dimension is more important. It depends on how you have driven the business. So product IT product companies, for instance, are more worried about which products are making money. They're less worried about the customers, whereas say professional services firms would be a lot more worried about customers and less worried about the product or the service line. Uh, to me, if there is a trade-off decision involved, then I would lean towards what you believe is a more critical dimension. Right. So to answer your question, if customer A is profitable and for you to maintain that profitability is what is absolutely critical, then that's what you will need to do. So it's very, and we come across several cases even in manufacturing, for instance, where let's say you maintain a number of loss-making products purely because you are known in the market to provide a range of solutions or products, right? So let's say you are selling 1,000 products and the bottom 400 are not very fast moving and they're not very profit making. Some of them could even be loss making. But the reason why you get business on the 600 fast moving products is because you maintain a tail of 400 slow moving products, right? So these are strategic decisions that will need to be taken. So, I mean, again, the purpose of the costing system is not to kind of tell you that stop the loss making product in under all circumstances. There could be a strategic reason why you want to keep a loss-making product going or a loss-making customer going, but at least a costing system allows you to make it a conscious call. It is not like you're losing money without knowing why you're losing money. If you're losing money and you have chosen to lose money for some time on a particular product or particular customer, fine. So a costing system will allow you to take a conscious call on how you want to view pricing, either for a product or for a customer. Actually, I see a number of questions. I'm not sure whether we'll be able to go through all of this because it's already 5 o'clock, but I'm going to take another 5 minutes and see how much more we'll be able to cover over here. Okay, the question is, how do you decide whether your costing or pricing is correct and as per industry norms or trends? Again, a very good question. See, we have to look at pricing from two parameters. One is an inside out parameter, which is what a costing system allows you to do. So you look at your pricing on a cost plus basis and say that, look, if 100 rupees is my cost and I want to make a 30% profit on my cost, I need to price it 130. That's an inside out view. But we all know that there is a market reality. And most companies, most mid-market companies in India are not price makers, they are price takers, which means that the market determines what is the price for that product. So let's say that in this example, the inside out view that your costing system is doing is telling you 130 as the pricing, but the outside in view, which is determined by the market, is telling you that the pricing should be 120. Right? To me, it is very simple. You will have to go by the market. If you want to stay in business, you'll have to go by market. Now, then you will ask me the question that if anyway you have to go by market, then why implement a costing system? It is about awareness. Because now you know that ideally you should have been at 130. The market is able to give you only 120. If you have to make your target profit, you have to save 10 rupees somewhere. That's where having a costing system that shows you exactly what is each component of cost will help you to determine where I can save that 10 rupees. So you got two choices. Either you leave at cost at 100, take the market price of 120 and take a profit of 20 home, or you can choose to say that my target profit is 30. If the market gives me 120, then I got to push my cost down to 90. Now, where that saving of 10 is going to come from is what the costing system will tell you. So to answer your question on how to determine whether the costing or pricing is correct, the ultimate judge of whether your pricing is right is the market. Because if it is not competitive, people will not buy. Right? A costing system cannot tell you what is the correct price. A costing system can tell you the right cost structure, and it will allow you to be aware about where you're spending the money, so that if you have to tighten your belts in order to meet the market expectation, you will be able to do that better. Okay, then I have a question that talks about, okay, while projecting future costing, how do I determine a rate at which cost grows for a new project? Okay, so it's again a very good question. It's a very fundamental question, I think, because a costing system, by definition, is a historical system. It is not meant to be predictive, right? It will analyze the past information, it will analyze the past trends, and from that, maybe you can draw some lessons for the future. But a costing system is not meant to be a predictive system to tell you where costs can be in another 6 months or 12 months' time. Right, so I think that's a short answer to your question. So a costing model, highly unlikely that it will be able to provide you with a view of where costs are likely to be in the future. Okay, then I have a question that if a new department, such as research in a broking firm, utilizes the assets as well as some employees of the existing firm, how to divide the cost for the same? Okay, so this is a very common problem, right? So when businesses start new service lines or new product lines, they don't have dedicated teams. They end up sharing some of the existing teams. And again, there is no right or wrong answer about it. One way to do it could be to use the marginal cost method to say that I'm anyway sitting on this cost and I'm anyway making a profit in my existing business. So this cost is fully absorbed. So I will not load any part of this cost on the new product or the new service or the new project. This is more a marginal costing thinking. The very scientific and very correct way to do this would be for the utilization of the assets and the utilization of the time of the people, the existing people, to be calculated, and that should be credited to the existing business and debited to the new project. What that helps to do is that you will be able to see the buildup of costs, right? So I think this is very common in, say, an IT project. So, for example, in my company, when we ran the IT project, we figured out that the cost of the IT project was not the cost of the IT tool. The cost of the IT project was the time cost of the people who were actually doing billable work for our clients, who got diverted from there, and who now were spending time on an internal IT project. So the salary cost that was being spent on them, we decided to charge it to the IT cost center. And we found that the cost of time was 10 times the cost of the IT product. So that is a true cost of IT implementation. So I think in any new project, if you're going to take a view that I want to know exactly what is the cost of the investment I'm making, then you'll have to track the utilization of assets and people. If on the other hand, you are saying that, look, I don't want to load the cost onto the new project, let it run on its own because I'm fully absorbing the cost, then you will end up taking the marginal cost approach. Now, which one should be taken in your company is what you need to decide based on how your management thinks and how you think. But I do think that we have run completely out of time. I can see that there are probably at least another 7 to 8 unanswered questions, and I do apologize that we'll probably need to kind of um, stop the webinar here and call it a day. But what I'm happy to do is to, because we do have the names of the people who have asked the questions, so I'm happy to kind of set up a time for a short call with you and to possibly share some thoughts on how one should be thinking about some of the questions that you have posed to us. I'd just like to conclude by thanking all of you for your valuable time. It's never easy to take out an hour on a working day, so truly appreciate your making the time to join this webinar. Needless to say, we kind of reach out to fellow professionals and to business owners once in 2 months. I'm sure my team has got your contact details on record, and we'll be very happy to partner with Ascent to send you details of our forthcoming webinars. Thank you especially for sending in all your questions. I think it was a session that seemed to have provoked a number of thoughts and inputs and feedback. So, please do keep your feedback coming. We love it. If you have any views on how you think we can make these webinars more useful to you, please do not hesitate to get in touch with me or with my team. Once again, thank you so much for joining. It's been a pleasure having all of you and to present this webinar to you. Thank you very much.